Right.
Hi, everyone. Welcome to the Timing Research Show for October 26, 2015. My name is David Kosmeter. I'm the creator of Timing Research, and today we are going to be talking about the 109th weekly report. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports, and you can download it there. Today I have Jonathan Rose hosting for the first time, so he's been on the show a few times and has been a great guest. So Dave Landry is taking a break for another week, and so Jonathan's here hosting, and I'm going to go ahead and turn it over to him.
Great. Thanks, David, and thank you for inviting me to host. Looking forward to it. We have a great group today. We have Doug Robertson from Top Gun Options, Neil Batho from TraderReview.net, Jim Kenney from Option Professor, and Glenn Thompson from Pacific Trading Academy. So we'll just go through. Doug, why don't you start off first, introduce yourself, and tell us a little bit about your site.
Hi, Doug Robertson here from Top Gun Options. Mainly we are focusing on options education. Two main traders and educators, Matt Buckley and myself. Mainly the idea is that we've got two different opinions, two different sets of ideas about options trading, maintain a classroom portfolio for everybody, do a lot of education. I tend to do a lot of volatility trading. Matt does a lot of directional trading. Between us, get a lot of good ideas, good thoughts. I'm not very promotional, I'm sorry about that.
Seems like you guys got it covered with volatility and direction, so that's a nice combination. And where are you calling from?
I'm actually down here in Port St. Lucie, Florida.
Oh, good for you.
Yes.
All right, let's go to Neil from Trader Review.
Sure. Trader Review, we use technical analysis. I use point-and-figure charting as my main analysis, and I use the Ichimoku cloud. I'll put them together for places to buy as well as my targets. And basically, using point-and-figure, we've timed every single market crash before it's happened the last 10 years. And I'll use my own methodologies that the whole market is based on the growth rates, future growth rate expectations. So that's why everything will be great and things keep selling off. Why do you wonder if they sell off? It's because the future growth rate expectations are going down. So even if companies make more money, if they don't do it at the same rate, the stock will drop off, and that's a big reason why people don't understand the market. And then it's the same thing on a turnaround. If things are really bad, but then they just get more bad but at a slower rate, the stock can rebound, and everybody thinks, stock markets don't make sense, but they do if you look at the future growth rate expectations.
Right, good stuff. And where are you from?
I'm up here in Canada.
Fantastic.
This week.
All right, let's go to Jim Kenney of Option Professor. Hey, Jim.
Oh, looks like he's having some kind of technical issues. He'll probably be back on here.
Okay. Well, we'll come back to Jim. Glenn. Let's go to Glenn Thompson then from Pacific Trading Academy.
Good morning or good afternoon, depending on where you are, Jonathan. Thanks again for having me. And I'm glad I don't have. Well, in the long run, I need to get my picture up here, but I guess for the interim, it's convenient because I can be in my PJs. But anyway, thanks for having me. And yeah, I'm with Pacific Trading Academy. Been with them since their inception 15 years ago. I've been trading about 34 years. I'm actually in Southern Cal right now, but I started my career from near where I grew up in New York City, or New Jersey actually, and worked in New York. But I'm a technician, and I guess my primary philosophy is look for those nexus points of congruence between time and price. I come out of the Gann school. I guess philosophically or theoretically, my view is a market's going to do, and I'm paraphrasing what Gann said, it's what it's going to do once it gets to its once an appropriate amount of time has elapsed. So primarily my approach is on all time continuums or windows, look for those points in time when I expect a change, and when I get closer and closer to it, I look to see corresponding price congruencies, using the standard fare of technicals, so forth. So I'm a technician. So I teach basic TA. I've worked with all spectrum of traders, pure beginners on one end, experts, and everything in between. So I earn most of my personal income trading, short-term trading the E-mini, and I do a lot of Forex in the evening and through the night. So that's a quick synopsis of what I do. But in terms of teaching, yeah, I'm sorry.
I don't know. Go. Continue. I'm sorry. I thought you were through.
Oh no, I have been kind of all over the compass, so to speak. Ironically, when I first started, didn't have a strong interest in the options. I've had a great opportunity to work with a number of great options traders. So I do both directional and volatility trading, as some of the other guys mentioned. But yeah, most of my own trading, again, is I'm doing the underlying in the S&P, but I also set up longer term trades and spreads and so forth and hedges. But yeah, so that's pretty much it. Yeah.
Great. Okay. And my name is Jonathan Rose. I'm the owner of ActiveDayTrader.com. I've been in the business for 18 years, all on the trade side. The last 4 years as a market maker on the Chicago Board Options Exchange. I left the options exchange about 6 months ago because the bid asks were getting way too tight and all the edge was gone, and I actually feel that the market's gotten so tight, even on some of the illiquid names, that I wanted to jump over to the retail side to take advantage of these prices that I feel are mispriced, especially all these different weekly options that come out. So that's really what I specialize in. I would say I'm 80% options. I look at global indices for more of a feel for direction and also for volatility, but I really like to concentrate on kind of off the beaten path type option plays. So it looks like, Jim, can you hear me from Option Professor? Okay.
Hey,
Jim was on, but maybe not.
Jim, you're still muted. There's a little menu at the top where you can unmute yourself.
Okay. Well, we'll come back to Jim when he's ready. But we're going to start. Let's get on to the questions. We'll start with question 2, and let's go back to Doug. And so, Doug, based on any technical or fundamental indicators, would you predict that the S&P index will move higher or lower from Monday's open till Friday? And then after that, if you would give us a confidence in your answer. Let's start with Doug.
Well, let's see here. I don't do a lot of technical indicator work, but I usually follow a lot of what drives implied volatility and volatilities and things along those lines. And right now, I'd say over the next week, I would say that we are going to be higher between now and Friday. And it's pretty straightforward. It's really, we're in the middle of an earnings season. Next week, or this week that we're in, we've got 93 major names that are coming out with earnings announcements. The predominant trend that we've seen is that people are beating expectations pretty handily. That's not necessarily a good thing because those expectations were wildly reduced. Mm-hmm. But we are seeing a lot of positive beats, and more than normal. And I think that that's going to be the main driver. We've got some big cap names coming up this week, and as those things jump up, it's going to move the indices. So, and the rest of the market's going to follow along. I'd say that's the number one thing that's going to push the markets around this week.
Correct. And what about a confidence level in that call?
Okay, I would say that I got about an 80% confidence in that, but I'm going to put this out there. By the way, I am not necessarily overall bullish, so don't mistake me what I'm saying here for a perma-bull type of attitude. I think that we've got a lot of huge risks out there, and there's a lot of potential for some big drops. I don't know when it's going to come. I don't know, what's going to necessarily trigger it. But the market has room to move down quite a bit. There's a lot of fear out there. There's a lot of anxiety. So that 20% represents the chance that we might have a fairly significant move down, which could be triggered by, anybody at the Fed saying something stupid, China having a problem. We've got a fairly major deal in Iran that's going on right now. We've got a lot of geopolitical stuff that could just trigger people running for the hills. So, that's my 20% worry.
Yeah, it's always out there. You never know when the Fed is going to shock the markets, or when China's going to get involved, or Iran. That's always a possibility. Why don't we go to Neil with Trader Review? Same question, Neil.
Sure, I'm just gonna do a quick screen share here. Can people see this chart here? No?
Yes.
Yeah,
Yeah,
you're good,
Yeah, I
Neil.
just brought this up on stockcharts.com because anyone can bring it up. So I just brought up the S&P 500 here, and you can see clearly where it broke down. We rallied back up exactly to where it broke down. So that's usually going to be your profit objective. But I still think we can go just a little bit more. So I'm going to go with up this week, maybe about a 70% chance. And this is a point and figure indicator that I use, and you can also use it on a linear chart. But what you have here is a scale from 0 at the bottom to 100 at the top. And it's just showing the maximum range that this chart went to. But if you look here at the bottom, 8%, and this was back in September, 8% of stocks in the S&P 500 were above their 50-day moving average. So that's extraordinarily low. I mean, it's very, very low. So almost every stock in the entire S&P 500 was below its 50-day moving average. And then you can actually trade this indicator from 0 to 100 and look where it starts to break out. And what we're looking at now is this is all the way up at 68%, which is pretty much a high for this indicator. And was the high back in April, and then slowly moved down May, June. And as this indicator moves down and stocks stay where they are, then what you're seeing is the big cap stocks taking control of the market that eventually crumble. So what we're looking at here is stocks above the 200-day moving average is only 36%. So that can go considerably higher. So these are a few of the point and figure indicators that I like to look at. Mostly they work for getting out of stocks at the top and buying at the bottom. And you can use them for price objectives, short-term, long-term. So that's about what I'm looking at right now.
Oh, good stuff. Neil, actually, when I got into the business, I used point and figures all the time, and I'm not sure why, but I stopped using them, but I always really liked them. I think they always told a ton of information. I'm surprised people don't use them more. So that's good to see. And let's
We heard
go.
that you guys use point and figure in Chicago. That's why I like to use it. I say, I'm pretty sure those options guys are using point and figure.
It was kind of funny when I first got into the business. I was a floor trader at the Merc, and people used to sit with doing point and figure by hand, and that's how people would chart by. It's the easiest method to chart by hand. So a lot of the pit traders would do that back in the late 90s and early 2000s.
Yeah.
So very, very interesting. Okay, let's go over to Glenn. Unless Jim, are you there yet?
He's having a problem with his microphone, so I don't know if he'll be able to join us at all.
Okay. Well, let's go over to Glenn. Same question.
Sure.
Glenn,
Yeah.
of the S&P?
Yeah. Well, I'll indicate I'm I guess going to play a little contrarian here. I'm bullish overall for the year in that wind continuum for stocks and equities in general. However, for the question, I think we'll be lower by Friday's close. What do I need to what can I click on to show a chart? Can you guys help me out here a second? Maybe I can.
Yeah. Glenn, on the left, there's a green screen share. If you just click that, you should be okay.
Okay. Oh, got it. Thanks so much. If I can, let's see. Can you guys? Are we able to? Do you have audio, visual?
I'm still seeing a boat.
You don't see the? Oh, let's see. Let me. I've got essentially the same chart. The previous speaker had up, but it's a daily S&P on my Metastock platform. Let's see here. If you don't, let me see. Oh, share. That would be handy if I click that. Let's try. You see it now?
We're still on the pirate ship.
All right, let's get rid of that ship. Let's see, maybe share. Well, so as not to waste time, gentlemen, it would be nice to see it. Anyway, I'll give you a verbal, and then we can fill in that. Hopefully, you'll be able to that the audience out there knows what we're discussing. The recent low that came in on August 21st, remember the big decline from August 18th, or actually, yeah, it was the 18th was a top, and then we by that following Monday, we had the big decline in equities in the stock market on August 21st. I believe corresponded with the end of a third wave, and so I'm talking about a little bit of Elliott structure. And then we moved up by the end of the week. That Friday, August 28th, had a little wave of what I think is a correction, fourth wave. I think the end of the bear market cycle was the bottom that came in on September 29. And I think all of the appreciation we've seen in stocks overall since September 29, the end of last month, through where we are today, is the start of a new bull market, wave one of a cycle, a bull market cycle. They are notoriously challenging to kind of forecast from a price standpoint their target. However, I believe from a proportionality standpoint, if we're not at the top, we are near so, and I expect a second wave decline to ensue any day now. It's possible maybe whatever comes from Wednesday's meeting with the Fed might be a catalyst or a trigger to bring about dampening, curtailing of the move up. But overall, just structurally, I expect we're going to move lower into the end of the week. Someone said that they were hard pressed to kind of figure out the timing of it. I'm not all that good at picking tops and bottoms. I am very good at projecting turning points. I have a turn point for which I have about a 92% confidence, and it's a longer term. It's not in the week, but to put things into context, November 23 is a key date for me. I propose it could plausibly correspond to the end of a correction, after which I expect the market to rally into the end of the year, and I've got a price target, possibly 2165. It may seem a little, well, it's about 100 points away from where we are right now, basis the current front-month contract in the S&P. But I expect overall the scenario at any point now in this week, I expect again to move into a bottom. It might be that bottom would correspond with that time point that I just mentioned in the third week or so of next month, after which that would be the onset or mark the onset of a third wave, which could possibly take out the old highs that came in on July 20th and May 19th. So that's kind of my projection for this week. I think will be lower, even though the thing that the contraindications and that I am concerned about, and I do agree with what everything has been said thus far. You got the inertia of the move. We got a lot of powerful factors. Just the inertia itself, the tendency for persistency looks good. We got an inside structure today thus far that tends to correlate about 70% of the time with continuation. However, I think, I don't know what's going to happen, what it's going to be specifically news-wise this week, but I think there will be a trigger to mark the onset of this initial impulsive motive wave up, and then a correction to ensue. So that we end the week a little lower, possibly around the area of 1995 is a plausible target that I've worked out by the end of this week. If we break down below the 1995 area, 1940 looks to be some support based on some Fibonacci stuff. But I would give that about 60% on the 1 to 10 scale confidence.
Glenn,
I wish I had my charts to show you some, fill this in, but I don't know why I'm not able. You guys can't see the screen, but
I wish you did too, because I've got just a few questions, just so I can understand as well. You're talking 1995 in the S&P?
As a support.
As a support, okay.
Yeah, if I'm correct, if my directional view is correct, I believe we're going to end by Friday lower. I'm not saying we're going to be there for. I'm less certain on that. That's just a zone of projected support that I've worked out. Now, first, in order to see that, we've got to break down below the 2022 area. We break down below 2022. You got a lot of support in that area. 1995 is the next target that I've projected as far as support. I can see that happening by Friday, certainly. I am less certain. I think the last time I was with you guys about a month and a half ago, I was bullish for that, for that same question, and I was about 90% confident. I'm less certain this time around because of what I cited. There's a lot of inertia, a lot of factors, all the factors previously cited by the previous two speakers. I do see that. It's just that from a wave standpoint, structurally, if I look at the preceding structure, the distance the market's already traveled off of that bottom from September 29 seems to be proportional to the preceding historical wave ones. Wave ones, though, were challenging. They're the seminal seed of motion. I wish we were, if I were speaking a month from now, it'd probably be a lot easier to project what I would interpret to be a wave 3. But given the history and the structure and the just the proportionality of things, I'm betting that we're at either at the end of this first wave of a new bull cycle, or if we're not, we would be by the end of this week, and as such, end up lower, relative to today's price by the end of the week. Yeah.
Okay. Thank you.
All right, I don't know why I can't get you to see the screens, because I had all kind of stuff up here, but in any way, the key point that I'm targeting off of and trying to construct and see some reconciliations with is that November 23rd window. I believe that's going to be a turning point. If you ask me right now, I expect it's more likely going to coincide with a market bottom, off of which, and then think about it from the potential run time and the on an assumption of some amount of linearity. I know that's an assumption, and I don't expect that to completely carry the market, but if we're in that third final part of next month, marking the onset of a final swing up into the end of the year, I can clearly see us being able to take out and form a new high into the end of the year. One final point in the bigger picture here, and as to why I'm bullish the market, for between now and the end of the year. I don't, fundamentally, I don't expect the Fed's going to raise rates until next year, 2016. Number one, also from a longer-term cyclical standpoint, fifth years of every decennial or decade tend to be years of ascension. So I'm bullish overall, but again, the specific question, where I think we're going to end up by the end of this week, I think we'll be lower.
What was the fifth year thing that you just said?
Going back 200 years, if you look at I think it's about, it's low 80%. 80% of the time, every fifth year of every decade for the last 200 years has been, stocks have seen appreciation. So we've got that longer-term graph, kind of structural cyclical component that augurs for higher prices or equity markets in general in the U.S. to rally in the fifth year of every decade. So if I'm utilize something like that as one component, that's not definitive, but it's one component I think about. I then ask myself, what type of generic events would need to occur on the fundamental front that will bring that about? What's going on? I realize all the issues, and I to a large extent agree with what everyone has said about the tremendous structural problems we have domestically and internationally. I kind of like the course the Fed is on in terms of being data driven. But I'm sensing from and I'm not a fundamentalist, but I'm not oblivious. I don't not take them into account. I'm looking at everything, but just primarily trying to coordinate my time points along with the wave structure that I feel are the most plausible counts, so to speak. I think this move up that began again, that bottom that came in on 929, I count as the end of a bear market's fifth wave. It's a cycle, but it's a part of a larger degree correction. I think we're still in a generic bull market going back, for years. And if I had my charts, I could be a little more specific. But
Glenn,
yeah, I don't want to take too much time.
Yes, Glenn, we'll come back to you. Lots of good stuff, but let's keep it moving. Yeah. I will share my screen here as well, and then you guys can see my screen, okay? Okay, yeah. So for what I think as far as the market, and I am not a technician. I trade off where I see value most in the options. My feel for overall bias in the market is driven by risk and the VIX. So the VIX got absolutely crushed in the last 30 days, right? It goes from 25 down to 14. The VIX is just a 30-day moving average of the amount of movement in the overall market. So in order to expect a big move with the VIX under 15, I think, in my personal opinion, it's highly unlikely. I think the VIX, if the market starts getting hit and the VIX does rally, I think that we have a chance of going down, but I think the SPX just broke out to the upside, taking out that 2044 level. What's lagging is the Russell 2000. Russell's been weak with the SPX moving, and as you can see here, I just overlapped the SPX and the Russell 2000 for the last 3 years, and they move together. I mean, they're not 100% correlated, but I wouldn't be surprised if the correlation is close to 68, 70%. And so right now the SPX broke out. I think the Russell is really, really inexpensive relative to the SPX. I think SPX, if you're going to hold above this, say, 2060, I am extremely bullish on the Russell, but I think that the SPX will continue to grind higher. I think the VIX will continue to go lower, and I think the small caps will catch up. I think it'll happen this week, if not next week. So overall, I am bullish. If the SPX can hold above 2060, I am 90% bullish for the week. But just overall, I'd say on that call, I'm 65, 70%, mostly because the SPX broke out last week, real strong move, and the VIX got absolutely just annihilated. And I think the market's got a really difficult time coming off when risk is coming out of the market that quickly. So let's get back on these.
Jonathan, do you mind if I mention something on the Russell side of things?
Please, absolutely.
Yeah, I was just going to mention that. I mean, from a fundamentals point of view, small caps move when there's hope that the economy is going to do well. And I think that one of the things that's holding back the Russell is that there aren't a lot of green shoots on the economy overall. The big long picture of the economy is, I mean, I'm not saying it's horrible. I'm not going to be doom and gloom here, but it doesn't look bright. And that's what usually drives the small caps, which drives the Russell. I'm a little worried that we're just not going to see the Russell rebound too quick unless we see some hope in the economy.
Right. I guess the same thing with a lot of negative talk with the SPX, and the SPX breaks out last week. And just take a step back and look at bigger picture, if the SPX continues to rally, it's just going to things don't just work on an island, in my opinion. They'll eventually pull up the Russell. I do a lot of relative value trading, so that's why trades present, because there's different opinions in the market. So that's what makes us,
I don't disagree with you on that. I think if the SPY or the SPX starts moving up strong, it will certainly drag the Russell along with it, and small caps will come along.
Inevitably, right?
Yeah. So I'm just not sure relative how strong the small caps will be.
Okay, so let's go on to our first question, which is what developing events will you be watching for the trading week of October, this week coming up? And we'll keep the same order. And Doug, all you, take it away.
Sounds good. By the way, a slightly off topic, I worked across the street from you for years.
For me?
Yeah, I worked at 400 LaSalle Street.
Oh, great. Very funny. We have a couple of other ties, which I'll tell you after the show.
All right, sounds good. What am I looking at? Well, I think the big event stuff. I mean, we've got a lot of just overall. I think the major driver, as I said, is going to be the earnings this week. I mean, that's going to be where all the headlines are going to be coming out of. But we've got the big economic picture stuff that's still floating around out there. China is flailing around trying to figure out ways to make its economy grow at a high pace again. Europe is figuring out how to prevent themselves from going into a recession. And then, we've got a bunch of little geopolitical things floating around out there that could pop up at any time. As far as inside the U.S., everybody's going to be paying attention to the Fed. I don't think there's a whole lot of. I don't have an expectation that the Fed is going to say anything too crazy, but everybody's going to be looking at the Fed so closely that we're getting back to the level of paranoia of how heavy is Greenspan's briefcase going into the meetings, kind of paying attention to that. So any of the Fed governors could say something that causes the market to react. Honestly, I don't think it's so much the items that trigger the market. I think the market's just ready to potentially do downward move. I mean, I know that directly contradicts my positive bullish week, 80% expectation that this week is going to be bullish, but I think that the market is just waiting for when's the next shoe going to drop. I don't know if it's going to happen this week, but it's just something is going to trigger the market selling, and it's going to move. So,
all right. Well, Thank you. Let's go over to Neil of Trader Review.
So I remember back in the 90s when we had the big tech boom and the US dollar was super, super strong worldwide. And for a couple years now, we've been moving back into that type of scenario. So the whole commodity boom has been totally deteriorating massively. And so what I think is happening with the Fed here is I really don't think they're going to raise rates, but they play a lot of shenanigans. So for example, if Yellen comes out and says, you know, we're not going to raise rates and we don't have any inflation, which is completely not true. Inflation's at least 5% a year, 7% a year if you look at food and other things like that. What happens if when she says that, all of a sudden the US dollar weakens over a few days, a week, and then a Fed governor will pop up out of nowhere and say, you know, I really think we should raise rates pretty soon. And then the dollar starts moving up and it goes up 1, 2, 3% just so it can stay where they want it to stay. They don't want the US dollar to go down, I believe, at all, very much, while at the same time keeping the low rates. So how are you going to do that? You can't keep saying we got to keep rates low, we got to keep rates low. Then everyone's going to think rates are going to stay low forever, sell the US dollar. So these governors will pop up out of nowhere. So if Yellen comes out and says, there's no inflation, the economy's not so great, we're not going to raise rates, and the US dollar goes down, watch for a governor to come out a couple days later, a week later, he's going to say, you know, I really think we should raise rates. And when you look at these inflation reports, what people don't realize is, I don't even know if you can get this formula online or if it's private or how they do it, but they will use car price, even though car prices go up, they will say cars have electric seats now and they didn't before, so you have more value in the car, therefore the price is actually down by our calculation. And they'll say televisions are going down, there's deflation in televisions, which is actually not true, it's just prices going down, it's not deflation. Deflation would be a shrinking of the money supply itself, causing prices to go down. And they will use these sorts of shenanigans to say there's no inflation. But there is. And so it's always in the government's interest to have inflation. And that's a quote by Bernanke or Greenspan. And so I don't expect the Fed to raise rates at all. Not for 6 months, maybe more. And as far as other indicators, what I'm looking at is the same ones that I used before. I'll just bring it up real quick. Screen share. These percent of stocks above their moving average. So I'm going to look for these to reverse 6% in any direction using point and figure. Whoop. So as long as these hang out in X's here, that means that the demand is in control. So on a short term, I'd look for this to stay in X's, and for a longer term, I would look for the 200 to stay in X's, which is down here. If this 200 reverses 6%, then I would certainly be looking to tighten up stops and get out of stocks if you do some short-term trading. That's it for me.
Great. Thanks, Neil. Good stuff. And then let's go to Glenn. Hey, Glenn.
What events were you looking for this week? Yeah, I think Doug and Neil both mentioned, I think the central factor obviously is whatever comes out on Wednesday, I guess, from the Fed. So that's the key fundamental event that I'll be curious about. Overall, in the net, I expect the market's going to interpret whatever happens pessimistically. I think en masse investors are not going to be pleased. What I anticipate, and I'm not all that good, but if I attempt to conjecture, I expect more of the same. And trying to interpret the equivocation on the part of the Fed I've been trying to do that for more than 30 years. Good luck with that. At least from my perspective, I'm not all that good at it. But so what I revert to is try and play to my strengths, which is trying to figure out technically what's going on, and then that points me in the direction of what type of things to expect on the fundamental front in the world. Again, yeah, I don't expect the Fed is going to. There's going to be some Fed speak, so to speak. I don't think they're going to raise rates, and the broad view of that, and I think reaction on the part of the equity market and the stock market in general will be negative. I think that will be the key component. Either way, if they have a slight bias of indication to suggest they're going to raise rates possibly in December, I think the market will look at that negatively because they're saying, well, that's kind of little boy blue. We're getting tired of hearing the same thing. If, on the other hand, they indicate that we're going to do it sooner or later, either way, I just think it's going to be the mass interpretation will be it will be price depressant for the market. I'm a derivatives trader, so I look at intermarket correlations. I'm bearish oil right now. I have a time point for that, November 6th. And I'm short oil. So in other words, to the extent from an intermarket standpoint, if oil prices keep dropping, as I expect they will, into curiously or ironically next Friday, the 6th, I expect further declines as long as that's the case. I don't expect. I think that would be a component the bank is going to be looking at as a delay. I'm not really seeing any indications worthwhile numerically in terms of inflation. So in pure numbers, I just don't see that the Fed has an incentive, if they play it by the book and objectively, to raise rates. But again, the market's going to eventually, it's getting tired of that. I even believe, it doesn't matter fundamentally whether the Fed raises rates or lowers rates, and even the timing on it. I think eventually, longer term, it's going to be positive. I read a report, there's some analysts at Deutsche Bank and JP Morgan that are expecting ultimately a rate hike could be price supportive for stocks, in that it's going to improve the banking sentiment. It creates a reaction on the part of the investing public. The stock market no longer needs the help of the central bank, and therefore it's a positive. So again, longer term, I'm very bullish. I just think more precisely the timing this week is we're due for a correction. But I would say that again, that's the key thing I'm looking at. I used to trade stocks, but I don't follow that as intensively as I used to. So I'm focused on intermarket relations, as I said, between oil, bonds, the U.S. dollar, etc. But I think the total net resolution of all these vectors is basically going to be lower. The reason I'll leave it there. Yeah.
Oh, okay. Thanks, Glenn.
Sure.
And then for myself, I'll go ahead and share screens again. I like to my trading, I want to keep things extremely simple. I want to take a step back, look at what the market's doing, and then try to find value around that. So again, SPX, long-term chart, getting over the 200 period moving average. That's what I'm just watching. I want to see how it's going to react, this 2060 support. Markets do not like to be around big numbers. If we go back historically and see how the SPX has reacted to its 200 period moving average, it's been great support over some time. So the same thing here. It gets under, gets over, real strong. Stayed under, sure. It tried to test again, got over, nice and strong. So that's why I'm really leaning. I think the market is exceptionally strong. I really do. And the longer that we hold up here, the more I think that we're just going to keep on rallying, especially with the VIX being offered. But around this time, and again, I was a market maker for 4 years on the option exchange, so I take pride in the fact that I can value options to the penny. I really look for earnings and stocks that are still priced cheap going into earnings. Sorry about that. So I'm searching for 2 weeks, 3 weeks, 4 weeks out to see how options are priced going into earnings. I think there's a ton of different names that are already priced to go into earnings. So therefore, if I'm able to buy the straddle or some options in those names, in my opinion, I get a free hold until earnings because stocks are already priced to go into earnings. The stock, here's a perfect example, United States Steel Corp. Looking at the options in United States Steel, earnings are next week. The straddle is about $1.40. And looking at that, the last 4 earnings for United States Steel have all been over 12%. So I don't think a name like this is going to decay at all into earnings. I think it's priced to go into earnings right now. So a trade like this, if I can get in, then I can scalp, maybe people aren't familiar with options, but I look to hold that position, scalp gamma, and then I'll cover that position before earnings. So that's really what I'm concentrating this time of year. So let's go back. Let me get my screen share off here. And now we're going to go on to Doug. And Doug, we're going to go to question 5 on the report.
Mm-hmm.
And let me just read it for everyone. Question number 4, excuse me. Did you watch the Democratic presidential debate last week? What do you think of Bernie Sanders' plan to break up the major banks? And let's start with Doug. Am I still sharing?
I almost religiously avoid politics.
Probably a good play.
My general opinion of politics is negative across the board. That includes both political parties. Okay, first of all, I mean, as far as Bernie Sanders is concerned, he is about as far left-wing as you can get. He's playing the populist card. I mean, by the way, I don't necessarily completely disagree with some of the stuff he says. I just don't think it's practical for him to think that he's going to go out there and break up the banks. There's this amazing misconception that the power of the presidency is like absolute. You wave a magic wand and you do stuff. It's like Donald Trump on the opposite side saying that he's going to build a big wall between us and Mexico, and then who was it?
Make the Mexicans pay for it.
Yes, make the Mexicans pay for it. And,
with money sent to them from the United States.
or who was that? Scott Walker saying,
as
well, I'm going to one up that, and I'm going to put one between us and Canada, which seemed completely bizarre.
Is that a new one? Who brought that one up?
No, Scott Walker actually said that a couple of weeks ago, that he wanted to put a wall up between us and Canada because of the obviously huge problem of Canadians rushing our border.
A lot of the Eskimos are coming down.
Those Canadians,
the ice is melting, so
80% of them are massing at our border right now. We got to watch out for that.
It's true. We could walk among you. You don't even know.
I know. My God.
All right.
They ask you where Tim Hortons is, and you're like, who is this guy?
I grew up in Maine. My backyard was Quebec and Nova Scotia. So, but as far as the politics, we're going to have people saying stuff left and right, and I think it's more of a game to see who can get headlines than anything else. I think the whole process is a joke at this point. So,
I think so as well.
Yeah. On a side note, a real quick side note, historically, if we want to go into trends and seasonality, election years are normally quite positive years in the market. Now, I have no idea if this election year is going to be a positive year, but usually there's a lot of people saying, I'm going to make things better, the world's going to be a better place, listen to me, elect me, and I'll put a chicken in every garage and whatever else they want to promise. But I guess we'll see.
All right, thanks, Doug. Let's go over to Neil.
I didn't watch it, but I'm reading all the comments on the PDF that was sent out. I think they're really funny.
Comments are great.
I really enjoy the comments.
Did you have a favorite?
Yes. Many favorites. Basically, okay. A lot of people don't know, but back in the 90s. was when Glass-Steagall got removed. And then you have the next president. Well, Bush didn't remove it, but then, now you had the president, or Volcker wants to put it back in, or something similar, in the current administration. And Volcker was the guy that raised rates to, 18% or 15% in the 80s and just crushed the growth of the money supply. And he wanted to bring something back, but guess what? He got kicked out. He got kicked out of the current administration. And why is that? I mean, obviously, the banks should not have as much power. They should not have the ability to use the money in your account for what they want. It's preposterous. You should have that Chinese wall that we learned about back in business school, but they don't. And so all this bringing back Glass-Steagall, these things, I just don't believe it's going to happen. The same thing, you could look back 40, 50 years saying, well, anyway, it's not going to happen. I think it's just a whole bunch of rhetoric, really. And what's amazing to me is that people buy the rhetoric.
Exactly.
It's just ridiculous. I mean, it's just, I just don't believe it's going to happen. Yeah, that's really what I think. I think a lot of other people feel the same way. So,
all right. Well, good stuff. I agree with you. I think a lot of people do feel the same way. That's just a bunch of rhetoric. Let's go over to Glenn of Pacific Trading Academy. Glenn?
Sure, sure. Again, I wish I could be more controversial, but I'm going to have to follow the consensus view here. I think it is an attempt, like I guess Doug mentioned, to a populist endeavor to appeal, and it is rhetoric as such. Having said that, there's some things that I do agree with theoretically, but the translation from paper theory into the real world, I just don't see it happening. There are some good ideas. I didn't watch the debate. I found out about it too late, and then I caught a couple of clips of it on the news, and I didn't even hear him talking. But when I, heard the question, I said, "Oh, I think Bernie Sanders has some ideas about possibly making structural changes insofar as the postal system, doing some participating to some extent in the for a certain segment of the population. In principle, I see there's some logic in that. I know that there's precedent for that, but in a big term structural way, breaking up the banking system, good luck with that. I just don't see that happening. It's kind of right up there. Here's an idea. It's not the same, but it's kind of by analogy. I'm a proponent, and theoretically, I think there's some positive attributes to a flat tax. Steve Forbes did that many years. He was espousing that and proponent of that years ago. Yeah, on paper, I like that idea. I think it would simplify life. But I think, just the very fact that it makes sense in a theoretical sense is why it won't translate and we won't see it manifest in the real world. I think I have a friend who's a CPA tax attorney who said, Glenn, yeah, there's too much money. There's a multi-billion-dollar industry, not just here in the U.S. but worldwide. So to simplify the tax code politically, what a fight! That I just don't see it anytime soon. Call me a Luddite, but it is what it is. I'm also a realist to that extent, and I just don't think. But it might sell to the masses who are maybe not thinking that at those extra steps to see what it takes. And yeah, whoever, I can't remember, someone made the comment that president, we assign too much power. The president is just one portion, and he's got to work with he or she has to work with the Congress. So it's more of a symbolic thing. I've always maintained the chief of the Fed and Supreme Court justices hold the most power. They're in for life if you're in the Supreme Court. And the Fed, kind of, in a sense, answerable to no one for at least the term, but they control the money, and that controls the power. But no, I agree with Doug and Neil. It may have made some points in the debate, but I don't see it happening in the real world.
Okay, thank you, Glenn.
I see it in football. How many times is Charlie gonna try to kick that darn football? Lucy's just gonna hold it away at the last second.
I definitely.
She's gonna go, no, this time it's different. I'm gonna hold that football. Charlie's like, okay. Holds it away at the last second.
So I definitely agree with the panel on this answer. My favorite part about just the whole discussion was the bill that he presented. It's 4 pages long. So it's a 4-page bill, and it's just saying there's a committee of 10 people. If a bank's over $50 billion, they have to be broken up, and then it's the Treasury Secretary needs to come up with a plan to break up the bank. So that's what the whole bill was. It was so incredibly vague that 50 billion, if it's over, we have to break them up. But then he doesn't tell us how we're going to break it up. Then the Treasury Secretary has to find a way, and this is in there. It said failure. He has to break it up, so failure would no longer cause a catastrophic event on the U.S. or global economy without a taxpayer bailout. So might be a good idea, but it's great. This is what I want to do. I want to break up the banks, but then Treasury Secretary, you have to decide how to do it.
Yeah, that's also making a huge assumption that breaking up a $50 billion bank isn't a catastrophic event.
Right, that is even possible. So, but it is helping him in the polls. So something's working in its favor. So I'm sure.
I got a quick question.
Yeah.
Sorry, just about the polls, because otherwise I would have forgot. Everyone's got a cell phone now, so who are they calling?
I assume that there's going to be internet-based and surveys being done, right? I don't think they're calling. Are you talking about how are they getting the information?
Yeah, I think he's asking. I think historically the polling organizations only called landline phones, right? And so have they? That's some. I don't know about that either. Are they calling cell phones now?
It's a good question.
Yeah, I'm not sure, but
I don't have a landline anymore. But legally, polling organizations can legally call cell phones. I don't know if they do, but legally they can. That's one of the exemptions from the list.
Okay, well, nevertheless, a lot of great stuff being discussed, and why don't we go we've gone through all the questions. Let's just go around for some closing thoughts, and let's start with Doug.
Closing thoughts. Wow.
Any closing thoughts?
I'm just looking forward to getting some clarity in the market. I mean, I've been professionally trading since 1999, and this market is probably one of the most challenging ones to trade right now. It's we've had a couple of really easy years where trades have just been pretty much handed to us left and right, and I think right now is the take back from that. The market's just making it very challenging to see clearly what's going on next. So let's get a little clarity in the market. I'm looking forward to having some of that.
Great. Okay, let's go on to Neil Batho of TraderReview.net. Neil?
Oh, it looks like he had some kind of technical issues, and he's logging back on now.
Okay. Well, why don't we, Neil? You up or can you hear us?
I'm back. I'm not sure what happened there.
Okay. So I've got some closing thoughts. Anything you want to add?
Closing thoughts for the week.
Whatever you'd like.
Yeah, I think stocks could go up a little bit more, but you got to be careful. Check out, raise your stops, and I think you need to also look at the U.S. dollar and see how that's going to be affecting the commodity prices. So we traded some commodity stocks for some rebounds. We did that on oil as well, but keep a good eye on the currencies and monitor those with your trading.
Great. And now let's go over to Glenn.
Sure. I think just as a recapitulation of what I said earlier, for me, the central question, number two of where's the stock market going to end up at the end of the week, boils down to a question of that bottom that came in, if you look at any major index, the Russell, the Nasdaq, all the major stock indices, the bottom on August 24th versus the bottom on September 29. My interpretation is that bottom on August 24th, the deeper move, corresponds to the end of a wave 3. I'm almost persuaded to see it the alternate way, which assumes it's the end of a 5th wave and the start of a new wave 1. If that's the case, and this is why I only attributed my forecast to, I only assigned it a 60% likelihood by the end of the week. Because that, if in other words, if the bottom on August 24 is the end of the bear market fifth wave, or the pullback rather, I think it's a correction, then that move, the top here on 9/17, September 17th, is the new one. Your correction 2 is the bottom on September 29, and that would make everything off of that bottom more recently at the end of last month the start of a third wave. And yes, in that case, that's the 40% of expectation that I would expect higher prices this week, assuming that description is carrying the day and what the market's hewing to. Alternatively, my alternate count, the one that I'm ultimately siding with, is that that bottom on August 24 is the end of a third wave. And the reason I'm selecting that is it's so powerful. It's got classic third wave written all over it. That move from the top on August 18, 3 or 4 days later, down to the bottom, it just went into free fall. So I think that's a third wave. On that basis, the move up to the interim top on September 17, again, I expect is your correction 4, and then we had what's called, what Elliott would call a truncated fifth, the bottom on September 29. If that's the case, everything since the end of last month, the start of, all through this month, October, we have been in a wave 1 of a new bull market cycle. I just think, again, that if it's not at the top with Friday's high, it's near so, and I think we will, by the end of the week, shift lower. Overall, though, again, I'm still bullish by the end of the year. And then one final point, touching on what you were saying earlier, Jonathan, about the volatility plays. I think the play this week, a strategy would be, and it's kind of scalping buying gammas or anticipating an increase in gammas and vegas to offset a loss of your time decay. If I had bought options if I'm trading stocks, find some stocks that are the front month option is moving at a faster rate, let's say, or the gammas are increasing and my vega overall is increasing faster than my theta decay after the earnings for the issues that are having earnings reports this week, and then sell it right before the after the earning, let's say, or alternative, do a straddle or something like that. So I kind of like your strategy there as a strategy for the week. If not, if you didn't do that about 3-4 weeks ago, I would be buying a straddle on the near the close today and look to get out like on Thursday's close in an anticipation of a volatility blow up and then a corresponding decline after the earnings come out. That's a strategy I would probably do for the week.
All right, great stuff, Glenn. Thank you very much. And then for myself, again, Jonathan Rose, active day trader, just about active day trader. It's just my trading style is trying to keep things very simple, looking at the big picture, and then just trying to find value, mostly in options, relative value type plays, relationship type trades. But I don't trade. For me personally, trading off technicals is not enough. I get into positions using fundamentals, and then I'll manage those positions with the technicals. So, and lastly, I just want to say, David from Timing Research, thank you very much for allowing me to host. Great panel today and really great discussion. So let's send it back to you.
Yeah, thanks, guys. Great show. And I don't do a lot of political questions in there, but good discussion on the banks and everything. So thanks for that. Just want to remind everyone watching to go to TimingResearch.com/reports if you'd like to download this week's or any past reports. Also go to TimingResearch.com/current survey next weekend to fill out the new survey for next Sunday's report. Join us again next week. Dave Landry will most likely be back as host, and Kurt Capra and from Pristine.com and a few others will join us. So I just want to thank all my guests for this week. Doug Robertson of TopGunOptions.com. It's their first time on, so thanks for being on today.
Thanks for having me.
Neil Batho of TraderReview.net and Glenn Thompson of PacificTradingAcademy.com. Thanks for being on again.
Thank you. Thanks, Dave.
Jim Kenney of Option Professor was supposed to be here, but he had some technical issues, so he'll be on again in the future. And Jonathan Rose of ActiveDayTrader.com. Thank you very much for hosting this week.
My pleasure. It was a lot of fun.
Appreciate it. So, all right, thanks, guys.
Fantastic. Thank you.
Thank you. Thank you.